Are you looking for a fiduciary? Somebody that will treat your money as if it were their own and they were in the same situation? Call the Financial Enhancement Group at 800-928-4001 or go to yourlifeafterwork.com. Find out what a fiduciary can do for you. What could possibly go wrong? Seriously, when you're looking at the financial world, what hazards get in the way of you getting to where you want to go? We're going to talk about hazards. I'm going to use it through golf analogies, challenges and things that can happen in your financial plan. But what went wrong on the way to the market? What things could possibly come up so that you have the best option, or the best opportunity rather, to succeed at where you're trying to get to? First of all, and I call them the 5 hazards of golf. And if you don't know why we're doing this in a golf theme, if you're not watching it on YouTube and you're listening on the radio, I'm in my golf shirt, I've got a hat on, I've got shorts, I am ready to go. And it's not that I don't take this very, very seriously. I had a friend that I used to golf with down in Montgomery, Alabama, and his name was Bobby Longshore. And Bobby had a job that looked like everybody else. The same role that I had with people from Tennessee to Alabama, down into Georgia. They all had the same job, and nobody liked these people. I swear their mom didn't like these people. And everybody loved Bobby. And I asked him, I said, Bobby, how in the world did you get people to like you in this role? And he laughed, and he said, Big Joe, in this Alabama voice, I learned a long time ago to take myself not so serious at all, and my job very, very seriously. Now, he, in his wonderful brogue accent of way of using it, reversed those. He said, I learned to take what I do very, very seriously, and myself not at all, and just laughed. But I always remembered that. And so if you're listening to the show, yes, I do try to have fun. What we take in the financial world is very, very serious. We treat it very, very seriously, but we try to have fun along the way. The people that we take care of, the average family has been with us longer than 8 years, and that's because we continue to grow. We're very, very proud of what we call our retention rate. We have long-term relationships, not short-term ones, and we continue to continue to build on that by not taking ourselves so seriously, but taking what we do very seriously. So this is a golf-themed show, and I'm going to have fun with it. Hazards on a golf course are when you get caught into things like sand traps. I would call that a hazard. When you go into the water, that's a big hazard. You can't get the ball out. You're going to lose a penalty stroke. When you go out of bounds, technically not a hazard, but it's out of bounds. It's a problem. But a hazard is anything that interrupts your opportunity to be able to get your shot to where it is you want to go to the next thing. It's anything that interrupts the lie of the ball. And remember, if you haven't been with us for the whole show, a lie is the condition that your ball is laying in, whether it's in the rough or whether it's in the fairway or the first cut or on the fringe or on the putting green or the tee box. Those are potential different lies that you can have along with the hazards that are out there. So what's hazard number 1? Focusing on the wrong thing or only one thing. Somebody asked me where I came up with the fiduciary focus. They couldn't find it on the internet, and you probably won't unless you find it something that I wrote years ago. I've been writing the newspaper column for 25 years, just like we've been doing this radio show that long. The fiduciary focus, as far as I know, is my thing. But what I realized was when you looked at the economy functions in a clock, if you will, if you trust the economists, that says you have a peak, a contraction, a recession, and an expansionary phase. So it works on a clock. And the reason the S&P 500 was developed was to be able to look at companies via stock price to see how they were performing. Well, not via stock price, the companies themselves on the balance sheets and their income. Bogle with the S&P 500 fund is the one that took it to a stock price. But the economists were able to look at the companies that were performing at various times to be able to concur whether or not we were in a peak or contraction or recession or expansion phase, the theory being different companies perform at different times based on the economic cycle. Well, the same is true inside of our financial plan. But what I realized is those 4 things of the fiduciary focus, risk and volatility, fees and expenses, taxes today and tomorrow, and real return, people end up focusing on the wrong one at the wrong time. For instance, when a market has been high for an extended period of time and continuing to go higher and higher and higher and higher and higher, What we watch is people get focused either on fees or expenses or taxes. This is not the period of time to be worried about that. It's risk and volatility. Risk and volatility because the market has had an extended or protracted upturn. It's time for it to start to make probably a downturn. You're closer to the end than you are the beginning, at least, of the wonderful period of time that you're in. On the other hand, when the market really gets beaten up, people get focused on volatility. Here's where we really want to look at making sure that we're taking advantage of some of the tax opportunities that are there, that are going on. And that takes us to number two, ignoring the other risks. Yes, you know principal risk. And I've said this for years, and please don't take this personal. I never ever mean that. But the majority of people who listen to the radio show or deal with fiduciaries, for all practical purposes, are what I call sophisticated savers. They put money in the market not because they want to own a percentage of Coca-Cola, but because they believe that it's a better opportunity to preserve their nest egg and their future wealth for their family and their charities and themselves than it is simply sticking it in a mattress. If the mattress would yield a higher return, there would probably be more money in the mattress. That is principal risk. When you put money and you're worried about just getting your money back, that is principal protection that you're concerned with. Principal risk. And you need to understand there's 11 or 12 other risks that go along with that. Right? So from a golf analogy, if you're thinking about taking the swing of the golf ball or of the club to be able to hit the ball, you can't just think about good contact. You've got to think about the direction that it's going, whether it's a draw or a fade or a slice or a hook. You've got to think about a lot of things other than just the swing. You really want to make sure that contact is good. Ignoring principal risk is a fool's errand. You don't want to do that, but at the same time, you've got to be able to pay attention to the other risks as well. Running out of choices would be the third one. Pretend like you've got your golf bag, you've got your 14 sticks, and for some reason or another, some of them are missing. You left them on a previous hole, and you don't have time to go back and get them. Well, that's what happens as we age. So when I call it running out of choices in the financial world, you have limited resources, right? So you either don't have income coming in, you have no wages. That controls where you're able to save and accumulate money and the amount you're able to save and accumulate. Either you've been laid off or you're disabled or you don't have a job or you've left or separated from the workforce. There could be a lot of reasons why you have limited resources, but you run out of choices in terms of where to be able to put that money. Next is age. The IRS does dictate based on this age, you can do this. For instance, if you're still working at 75, you can put money in your 401k as long as you're not the owner of the plan or the company. On the other hand, you can't put money into an IRA even if you're still working, right? So you get some of these crazy options and opportunities that are out there, but you want to make sure you don't run out of choices. When we look at the fiduciary focus, right, and we tell you to pay attention to your financial vision, understand that tax planning is number 3 in the fiduciary focus. Tax planning both today and tomorrow. You're looking at that runway. How long until I can use my money? How long until I need to use my money? What's my income going to look along the way? Another one of the running out of choices is where you work. If you work at a company that has a 401k versus one that doesn't, or a 403b versus one that doesn't, or one that has a Roth option versus one that doesn't, or one that has in-service non-hardship distributions, or one that doesn't. Those are options that you have that are limited by where you look, and you need to be able to be aware of those and understand what's going on. When you're 25 and 30, does it matter? You bet. And don't let anybody tell you that it doesn't. Now, some options matter more than others. Number 4, fourth hazard, forgetting it's income at retirement, not assets. There is nothing like setting people up for failure. And that's really what my industry does. Wall Street gets paid based on activity. They don't care if a market's going up or if a market's going down. They make money based on the activity. That's you buying or selling. They know that the market is driven by greed when the market's going up and by fear when it's going down. And by the way, fear trumps greed every single time in psychological decisions that have to be made. So for all of these years, from 1996 on, We've been forced to send you statements quarterly, monthly if there's activity, and you've had the internet access to be able to get information all of the time. And that data has been coming, and you've gotten used to being able to look at a number. And it doesn't break down unless you're looking at one of our statements at the Financial Enhancement Group. It typically doesn't even break down if it's IRA money versus non-IRA money or Roth money. You need to know that, and that's why our statements actually provide that data. Regardless, people look at this number, and we start to think about it's the asset. And I tell people it's their baby. You would invite that statement to Thanksgiving if you could figure out how, right? It's your baby, it's your assets, and that's what we're used to having. Well, retirement or separating from the workforce really isn't about that. It really is about income. And having that emotional shift of it being about income and not about assets is a difficult task. I'm there with you. I'm 55 years old. I've saved, accumulated. The numbers start to get bigger, right? And you look at them and you think about the day when you're going to pull money out as opposed to put money in and watch it grow. I get that it's difficult, but that's the process, ladies and gentlemen. Separating from the workforce, living off what you worked with is about income, not about assets. And you have to prepare for that emotional part. There's going to be a period of time when on the golf course we'd say, take your medicine. You know, you've got to swing from underneath the trees, know that it's not going to go where you want it to go. And that's the same thing here. It is about income, not about assets. Your value on your assets may go down, but you've got the income, and that's what you saved it for. Last but not least is checking it off and forgetting about it. It's real easy for people to say, well, I made the decision. I met somebody at Purdue University last year, the year before, that made their election when they first started in 1968 and had not changed it in their retirement plan until they retired. Found out they had a couple times because they moved providers and they were forced to. Other than that, they set it and forget it. Folks, that is not the best strategy. That is not the way that we want to do this, especially with legacy plans, tax planning, your investment playbook. We need to be monitoring and looking at this all the time. You can get more of that, more information like this, but call us. Get something unique to you. Let us help you look at your financial journey. We do that with our Next Steps program. You can go to yourlifeafterwork.com at 800-928-4001. Either way, sign up for a meeting. We'll give you 90 minutes of our time to give you things to consider today, things you're going to want to consider in the future. And if we choose to partner together, what FEG will do for you, and we'll put it into writing. Again, it's yourlifeafterwork.com. That's what it's really all about. What is your favorite hobby? You know, we all have things that we like to do. I love to read. I love to scuba. I love to ride around on my Jeep, but I really, really, really enjoy golf. There are a few things that can make me as happy or as frustrating as that singular game that was invented years ago in Scotland. The financial world is very, very, very similar to golf. And if you are just seeing the end of the show, you may want to go back and listen to the whole thing. If you missed it on radio, you can always get it on our podcast, Your Retirement Playbook. Or on our YouTube channel at the Financial Enhancement Group, your Retirement Playbook. More than happy to help you get there to find it. If you've got any questions, it's 800-928-4001, or you can go to yourlifeafterwork.com to find it. Here's the deal. With golf, I have to look at a lot of different things, and it's real easy to focus on just a few. And the less I knew, the easier, actually, that's not true. The less I knew, the harder golf was. The more I do, the more I know, sometimes the more frustrated it can become because I know what I want to do and I accidentally fade it or draw it or do something where now I know a little bit more. Well, it's that double curse of knowledge that we talk a lot about on this show. The double curse of knowledge, the curse of knowledge, as they say in psychology, is I don't know what you don't know. I've always looked at it a different way. The curse of knowledge is I don't know what I don't know. The double curse is I don't know what you don't know. And we tend to talk to people in a way where you think about what I'm talking about. And the more I know something, the more I presume you understand it and you know it. And that's just not true. In fact, what most of the time we presume you know is the most important part of the conversation. So at the Financial Enhancement Group, I've always tried to go back to basics. I've tried to get people to understand the 5 critical elements, the fiduciary focus, the 4 things you have to pay attention to, the 3 phases of finance, accumulation, preservation, and distribution. I've tried to get you in the right mindset to be able to understand what's going on and not just talk into oblivion about things. I use golf or cooking or scuba just to try to give you things that may resonate with you so you can better understand how your money works. You can walk up to a golf ball and have 3 clubs in your bag, or you can have the 14 that you're allowed to use. In the financial planning world, it's like the Cheesecake Factory. You've got 250 options, probably more, that you can make. They're not all wrong, they're not all right, but some are going to work better than others for you, for your journey. Give us a call at the Financial Enhancement Group, 800-928-4001. Go to yourlifeafterwork.com. Get signed up for your Next Steps meeting. Your financial journey is important, and you really only get one shot. I've been more than happy to share a cup of coffee and sit down with you. Have a great week.